Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. The great tariff inflation tsunami finally hit, and it was a wet sock. For the first time in Trump 47, inflation rose last month, and even that could have more to do with Congress failing to cut spending like they've been promising since at least 1933. Last week, the Bureau of Labor Statistics released June CPI and PPI numbers, CPI being consumer prices and PPI being what companies pay for their inputs, which is basically wholesale prices. So headline consumer prices bumped up to 0.3%. That's up from 0.1% the previous month, but wholesale prices actually came in lower, flat on the month. So that all brings consumer price inflation since Trump took office to an annualized 1.8% and wholesale inflation to just 0.8%, both being below the Fed's target inflation rate of 2%. So the biggest driver in consumer prices was energy, which was up almost 8% on the month on production cuts in OPEC and Russia. Meanwhile, new American drilling, Drill Baby Drill, is not yet online. The other inflation driver was housing, which actually went down on the month, both rents and house prices. But the Bureau of Labor Statistics uses a bizarre lagged measure that is still counting Bidenflation. Nonetheless, the media ran with that one. Still, after energy cuts and housing hallucinations, a close third was tariff inflation. Clothes were up 0.4% on the month. Household furnishings and consumer electronics were up 1%. Toys and household appliances, most of which are made overseas, went up between 1.5% and 2%. Of course, imports are just 1/9 of the American economy, with a big chunk exempted from tariffs under NAFTA successor USMCA, meaning import inflation came to just 0.1% inflation across the board, a wet sock. Last week I mentioned how even mainstream economists are now pegging tariff inflation for the year around 0.7%. That's one time, and for perspective is what Bidenflation was running per month. Noting that Bidenflation, of course, had zero benefits for Made in America or generating tariff revenue to offset income tax cuts. In short, so far, tariff inflation has been a cardboard Armageddon a fairy tale government-funded economists use to scare voters. What is scary is the money printing Congress has failed to rein in. Just last week, what should have been a sleepy $9 billion DOGE cut to USAID and NPR needed J.D. Vance's tiebreaker to pass the rhino-infested Senate. Meanwhile, deregulation, which could lower costs 20 times more than tariffs, is being blocked by rogue judges and rhinos in Congress who refuse to rein them in. This keeps inflation going while both oil drilling and tariff-induced reindustrialization take a long time, many months, if not years. And of course, they could ironically fuel inflation in the near term as banks print up investment loans on top of the $2 trillion federal deficits. So as next, I've been skeptical of the doomsday tariff inflation, but I've been equally concerned that federal spending is the doomsday. It won't get nearly as bad as Bidenflation when the Fed printed nearly $1 in $3 in existence, but unless Congress has a foxhole conversion when the upcoming $1.6 trillion federal discretionary budget hits, Trump is going to have a very hard time keeping inflation low, even if growth takes off. America's renter population just hit a fresh record at 46 million, meaning some juicy bonuses for corporate landlords. It's been a while since you've gone to a housewarming party. There is a reason young people are not buying houses. In fact, the average home buyer in America is now 56 years old, as in they are buying second homes by the lake. That's up 7 years since just 2 years ago. Even the average first-time home buyer is now 38 years old, which is a bit long in the tooth to be starting a family. 1991, the average first-time buyer was 28. The reason, of course, is cost. In the past 5 years, the median home price is up by over 30%, hitting $417,000, while mortgage rates tripled, put them together, and housing costs doubled, especially for new buyers. Meanwhile, buyers now need to earn $127,000 to afford the median home, That's up from 79,000 just 4 years ago. There are not many 20-somethings making 127. Harvard estimates just 1 in 7. Now, this is all crushed first-time homebuyers who've gone from 2.1 million 10 years ago to just over a million. Adjusting for population, that's an almost 70% drop. This is all music to the ears, of course, for the giant corporations whose access to cheap Fed-subsidized loans means they now own 1 in 4 rental houses. It's not so great for renters, so housing makes up most of Americans' net worth. According to one Federal Reserve study, the median net worth of homeowners is roughly $400,000. For renters, it is $10,000. So what's next? To get renters back into homes, there are 3 big moving parts: home prices, mortgage rates, and household incomes. Recent video I mentioned that home prices are already dropping thanks to a flood of home sellers, but going by history, that's probably good for a 5 to 10% drop at best. Toss in mass deportation, and maybe you hit 10 or 15% for starter homes. Now, the Fed could actually make home prices go down hard by selling the $2 trillion of mortgage bonds they bought during COVID, but that would get pitchforks in the street. As for mortgages, there's some relief on the horizon if the Fed cuts rates, which could reduce mortgage costs by 15 or 20%. Still, at best, that all might bring down the income needed to qualify to maybe $100,000, which is still science fiction for a lot of 20-somethings, especially if they're single. Which all leaves the last man standing, raising incomes for young people in blue collars. I recently reported that under Trump, blue-collar wages hit a 60-year high, and mass deportations, reindustrialization, and lower taxes and red tape should keep that going. The elephant in the room is young people are not getting married, which makes it very hard to clear even $100K in your 20s. Happily, surveys say a main reason young people don't get married is stagnant incomes. So fix the incomes, and to a degree, you fix the marriage. Fix both, and young people can afford a house again, going from hand-to-mouth renters with $10,000 to their name to homeowners building a future. A word from our sponsor. If you own gold or silver, you know they're a great hedge against financial instability and let you grow your wealth outside the banking system and gain greater control over your finances. Monetary Metals offers you the ability to increase your precious metal ounces every single month. Instead of paying to own metal, with Monetary Metals, you get paid 4% on your gold paid in more ounces. Now's the time to secure your wealth and build your legacy in an asset that the government cannot inflate away. Join thousands of investors earning interest in physical gold and silver every month with Monetary Metals. Visit monetarymetals.com/Peter to learn more. Now back to our show. Trump's trade deals are coming in, and they are obscenely in America's favor at last. Last week, Donald Trump announced a pair of trade deals with Vietnam and Indonesia, which are our 6th largest and 16th largest importers. Now, these countries send nearly $200 billion a year to the U.S. and import just $23 billion in return, so barely over a tenth. And both countries, but especially Vietnam, have become offshore manufacturing platforms for Chinese companies dodging American tariffs. To the point, nearly 1/3 of Vietnam's workforce is producing goods for export to the U.S., often for Chinese bosses. 1/3 is a lot of leverage, and Trump is using it. So the new deal with Vietnam lays on permanent tariffs of 20% with a 40% tariff for transshipped goods from China. Meanwhile, Vietnam is removing all tariffs on American goods. The deal with Indonesia is almost identical, suggesting this is Trump's new baseline. So Indonesia gets a permanent 19% tariff on Indonesian exports to the U.S. and also 40% on Chinese transshipments, and also 0 tariffs on American goods. Indonesia even threw in a sweetener, promising to buy $25 billion in U.S. goods, including energy, farm products, and 50 Boeing 777s. Now, these are lopsided deals, which makes sense considering they need our market a lot more than we need them. 30% of the workforce is basically an economic colony. The real mystery being why American presidents spent 80 years throwing away that leverage, instead seeking reciprocal deals with midgets who wouldn't even live up to them. The Indonesia deal is particularly interesting because while Trump had Vietnam by the balls with 30% of GDP, Indonesia's exports are 15 times smaller. Yet, they took a deal that's almost as bad, suggesting Trump is going to be able to nail down a lot more of these deals. Note, every deal Trump cuts puts pressure on the holdouts, because if, say, Korea is facing 40% tariffs while Vietnam's at 20%, they are priced out. It is a giant sucking sound. This is especially true for China, who is the main competitor to Vietnam. So far, China has been holding out, praying tariff inflation erodes Trump's popularity. But this is not happening. 4 months in, we're looking at something like 0.1% in tariff inflation, meaning the pressure is now growing as Chinese factories fall silent and potentially millions of workers face layoffs. Interestingly, China had been threatening other countries that dared to make a deal with Trump, but now their top competitor and neighbor, Vietnam, has made a deal. There is now a very enticing path for Chinese manufacturers to close up shop and move to Saigon, where, after all, wages are 4 times lower than China. So what's next? Trump is finally leveraging America's dominance as an export market instead of playing sucker at every table. Expect more deals in export-dependent countries from Thailand and Korea to Morocco and Mexico. As for China, President Xi's painted himself into a corner. There are already rumors of factions in the party edging him out over the trade war, and Xi has responded by being much more conciliatory than last trade war in 2018. The fact that America is seeing almost no inflation while China is seeing thousands of shuttered factories means time is not on China's side. They have to come to the table, perhaps with a similarly lopsided deal that opens up to American energy, farm products, and even cars and manufacturers. New York's communist mayoral candidate Zohran Mamdani wants to empty the prisons and, quote, abolish private property to drive the remaining solvent and non-criminal New Yorkers to Dallas and Miami. What was once America's greatest city, let's be honest, it's been a while, is poised to take another step to Venezuela as Democratic Socialist Mamdani fleshes out his economic plans. In a recent speech, he declared that prisons are, quote, obsolete, adding, quote, violence is an artificial construction. A 2020 interview surfaced of him calling for the, quote, abolition of private property to guarantee free housing to, among others, New York's estimated 672,000 illegal migrants, over 400,000 in the city alone. While media dismisses the Bolshevik agenda as rhetoric, it's worth noting that cities actually do have the power to seize private property, so-called eminent domain, ever since an infamous 2005 Supreme Court decision called Kelo versus City of New London that allowed the city to seize a woman's home via forced sale and turn it over to a developer. Of course, under Mamdani, there would be no developers. He'd be seizing homes and small businesses and turning them over to New York's notorious housing authority, or perhaps convert them into government-run grocery stores, which he has also promised. Meanwhile, between his promised tax hikes, reduced policing, and collapsing city services, with pothole and sanitation money going to LGBT activists, expect an exodus of middle-class New Yorkers, as well as the Wall Street firms who sustain New York's tax base. After the Democrats wiped out last year, losing the House, the Senate, and the White House, they held a series of high-powered retreats to figure out what went wrong, characterized in the media as a, quote, civil war. The moderate faction, led by Schumer and Pelosi, argued for coming off the ledge, pivoting to pragmatic policies, and bipartisan cooperation with Trump on things like wokeness, infrastructure, and the border, even trade, where Democrats have long supported tariffs. The idea being work with Trump on so-called 80-20 issues where voters overwhelmingly agree with Trump, so the border, criminal illegals, men and women's sports. Meanwhile, the other faction, led by radical progressives like AOC and Jasmine Crockett, argued they didn't crazy enough. What they need to do is go to war with Trump, doubling down on wokeness, social justice, racial and income redistribution, including a wealth tax, and defunding police to fund pixie-fart Green New Deals that crush jobs like Mamdani is promising. Now, the New York election was a test of who's winning, with Mamdani now the poster child of the radicals, and they are on the rise. So what's next? Mamdani's odds are coming down as New Yorkers get to know him. Still, prediction market Kalshi has Mamdani at 71% odds of winning the election in November, which is 4 times his nearest competitor, disgraced former Democrat Governor Andrew Cuomo. The Republican, Guardian Angels founder Curtis Sliwa, is running just 2% on Kalshi. It is, after all, a one-party city. New Yorkers are on the edge of destroying their city and their party. A true stint in the wilderness may be just what it takes to gut and rebuild the National Democrat Party. Unfortunately, New York would take a lot longer to rebuild. Going by Detroit or Baltimore, once you chase out the middle class, they do not come back. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada and they're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. The AI job losses are here. How bad will it get? And where will the new jobs come from? Last week, Salesforce.com disclosed that AI is now doing between a third and half of its internal work. They've already reassigned 500 workers to other roles and laid off 1,000. Microsoft plans 15,000 layoffs, including 6,000 software developers, also citing AI, Clippy's revenge, and so much for Learn to Code. Visa cut 1,400, Facebook 3,600, Intel 5,000. Even Chevron and British Petroleum cut a combined 17,000 jobs, citing artificial intelligence. The Wall Street Journal estimates U.S. public companies have laid off 3.5% of their workers over the past 3 years. Now, interestingly, they've laid off 4.5% of executives and over 6% of middle managers. Now, AI hitting white collars should not be a surprise. Mike Rowe, host of Dirty Jobs, has long predicted that AI would wipe out white collars, with electricians and pipe fitters inheriting the earth. Still, there's a lot of white collars. That's most jobs in the U.S. McKinsey says AI could affect 12 million jobs by 2030. That's 2 million per year. Brookings predicts 36 million. The OECD estimates 1 in 4 jobs are at risk of automation. Now, this all sounds dire, but remember, we've had comparable waves of automation many times in history, from agricultural mechanization to the internet in the 90s, which was also supposed to wipe out the jobs. In fact, tech making humans useless has been predicted for literally thousands of years. Aristotle worried about ox plows replacing agricultural workers. Medieval Europe had a job scare over watermills, and yet it never happens. The reason is human wants are unlimited, so as tech makes us richer, whether it's ox plows or supply chains, stuff that used to pay little or nothing now pays well enough to be considered a job. So actors used to be in line with prostitutes, now they're millionaires. Personal trainers in high automation America make 10 times what they make in low automation Honduras. In short, automation is an escalator. You take one step down, but pay for everything else goes up even faster. So what are these new jobs? In short, anything where human presence is the value. Consider that handmade things cost more than factory, even though handmade has more errors. Or that vending machines have existed for a century, yet bartenders have tripled since 1900 per capita. In the 1960s, stadium concerts barely existed. There were just 3 between 1965 and 1970. Today, there's 500 a year, despite the fact you can watch concerts for free on YouTube. 1970, there were a dozen comedy clubs in the U.S. Now there's over 1,000. So we're talking bartenders and YouTubers, nurses and caregivers, people who make things by hand, therapists, tutors, private chefs, travel guides, stylists, decorators, personal trainers, dance teachers, diet coaches. In short, we replace the cubicle farm with an economy made of humans. And when the dust settles, we're probably looking at a temporary, maybe half-point rise in unemployment while people shift into new jobs, ones that pay even better, specifically because of the background automation. So what's next? AI will transform tens of millions of jobs. In the near term, this transfers wealth to blue collars and away from journalists. In the long run, it makes our economy far more human than the soul-crushing cubicle farms that future generations will look upon with pity. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.